In this presentation, we will take a look at credit for elderly or disabled. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Requirements: qualified individual, and there's going to be some income limitations. What is a qualified individual? For the elderly or disabled credit, a U.S. citizen or resident alien, age 65 or older, or we can be under age 65 but meet 3 requirements. So typically the norm would be over age 65, or the exception under age 65 with these 3 conditions: retired on permanent and total disability, received taxable disability income, and have not reached mandatory retirement age. Here is a flowchart that can help us out through the general kind of questionnaire for it. We won't go through all of the options here, but we'll go through the easy one, the general one, the usual one. So were you married at the end of the tax year? If we say yes, we're going to go to this side. If we say no, we're going to go down. So let's say if we're not married and go down, are you a U.S. citizen or resident alien? If the answer is yes, then we can go down to the next item. Were you 65 or older at the end of the tax year? If the case is yes, then we go right over here and say you are a qualified individual and may be able to take the credit for the elderly or the disabled unless your income exceeds the limit, and then we can see the limits, which will be on table 1. So that would be the typical kind of flow through. You can go through some of the more unusual type of situations with a flowchart such as this as well. So how much is the credit? How do we calculate this thing? In order to do so, we need to first start with the base amount. We're going to start with the base amount, then we're going to have some limitations to it. So the base amount of the credit is going to be $5,000 for single and $7,500 for married filing joint. As we think of these credits and the amount for them, note and remember that we're not talking about a deduction. We're talking about a credit. It's going to be at the end of the page 1040, and it's going to be something that's going to be equivalent to basically a payment that was made into it. So in other words, whatever the credit is, an equivalent deduction would be much less. The credits are going to be typically better from a dollar-to-dollar standpoint. We'd rather have a $1 credit than a $1 deduction, in other words. So base amounts are reduced then by non-taxable Social Security. So if we're receiving Social Security, then we're going to take this base amount and we're going to reduce it by the amount of Social Security that's not taxable. Right there, you can see that this gets a little bit complicated because the taxable amount of the Social Security is not the easiest thing to get to. So we're going to give a general, basically, idea here, and obviously tax software would help to determine both this amount and this calculation for the deductible amount to base the credit on. 1/2 of the amount of the adjusted gross income exceeds the allowable base amount, these being possibly different allowable base amounts for this calculation. So once again, 1/2 of the amount of the adjusted gross income that exceeds the allowable base amount of $7,500 for single, $10,000 for married filing joint. And then we have the credit is 15% of the allowable base amount. So you can think of it something like this. This base amount starts off pretty high, and you can say, well, that's a big credit. But then, of course, we have to reduce it by the non-taxable Social Security, which could be significant. And so we got to reduce it by the amount of Social Security we got that we didn't pay taxes for. And then we got to reduce it by 1/2 of the AGI over the base amounts that we took a look at. And that'll give us some amount here that we're just kind of giving an example of numbers that we would reduce by. Then that's going to be the allowable base amount. Once we have the allowable base amount, we would multiply that by the 15%, and that'll give us the credit. So it's kind of, we have to go through some steps in order to get to the credit. It can be kind of deceiving when we start thinking about, what is the base amount and how to reduce the base amount. It's a little bit more complicated to calculate the credit than we might think at first glance, both because of this calculation and because we have to know things like the taxable amount of the Social Security. This is an area where the tax software helps us to be able to put in some scenarios and kind of get a feel for the range of this credit, where it will basically fall based on different AGI limitations, different qualifications, and different circumstances. For more accounting information and accounting courses, visit our website at accountinginstruction.info.